Chapter 11 is all about a simple idea: risk down, reward smart. If I can control my downside while still giving myself a shot at profit, I stick around long enough to win. First, leverage. Options can shrink my upfront cost compared to buying stock, and with that, my maximum loss. If I'm bullish, a long call can replace a long stock. My risk is just the premium. Profits may build slower, but my worst case is capped. I look for relatively low implied volatility, so I'm not overpaying and getting crushed when IV drops. If I'm bearish, I'd rather buy a put than short a stock. A long put limits my loss to the premium. A short stock can, in theory, go infinitely against me. LEAPS, those long-dated options, 9 months to 3 years. Let me mimic stock exposure with less capital and risk. Think of them like extended warranties for my thesis. But options come with a clock. Time risk is real. I pick a time frame that matches my idea, and I'm disciplined about exits, especially before time decay accelerates. Now, combinations. I can pair options to reduce risk further. Either cut net cost or widen the lane where I can still win. If my short option is backed by stock or a long option of the same type, it's covered. If not, it's naked, and that's riskier. Debit spreads first. Limited risk, limited reward. Bull call spread. I buy a call, sell a higher strike call. Max risk, the debit I pay. Max reward, the spread between strikes minus that debit. Bear put spread. I buy a put and sell a lower strike put. Same idea, less risk than a solo long put, with the debit as my max loss. The trade-off? My upside is capped because my short option puts a ceiling on profits. Credit spreads, also limited risk, limited reward, but I get paid up front. Bear call spread. I sell a lower strike call, buy a higher strike call. If I'm bearish or neutral, my best outcome is keeping the credit. Bull put spread. I buy a lower strike put, sell a higher strike put. If I'm bullish or neutral, max reward is that initial credit. For both credit spreads, max risk is the distance between strikes minus the credit received. Crucial rule: if price is near my short strike on the last trading day, I close the spread for a debit to avoid assignment surprises. So, Chapter 11 in one line: use leverage to cap risk, use spreads to shape risk, and respect the clock. Manage the downside, and the upside has room to show up.